Okay, so you want to own a mall. You picture the fantasy immediately. A gleaming building full of stores. Shoppers wandering the concourse with bags on both arms. Every single one of them paying rent, indirectly, just by walking through your doors. Hundreds of businesses, all working for you, all funneling money into one address. You built nothing, you sell nothing, you just own the box and the box prints money. That is the dream. The problem is what happens between the dream and the reality. Because a mall is not really a building full of stores. Think of it more like a landlord running a private toll road, except the toll road only makes money if people actually want to drive on it. And getting people to want to drive on it, year after year, decade after decade, turns out to be one of the most brutal financial balancing acts in commercial real estate. Here is the question that should follow you through this entire story. If shopping malls are just buildings that collect rent, why have hundreds of them gone bankrupt, been abandoned, or been demolished, while a handful of companies have turned the exact same business into one of the most reliable income machines in America? Start with what you are actually buying. You are not buying a building. You are buying foot traffic and then renting access to that foot traffic to other businesses. A mall works like a farmer's market with better air conditioning. The market operator does not sell tomatoes. The market operator sells the crowd. Every stall pays for the privilege of standing inside a crowd someone else assembled. The bigger and more reliable the crowd, the more each stall is willing to pay to stand in it. So before you make a single dollar, your entire job is to build a crowd. That is expensive. A modern enclosed mall in the United States can easily run into the hundreds of millions of dollars before opening day, and the biggest projects run far higher. Land, steel, concrete, parking structures, HVAC systems large enough to condition millions of square feet, fire suppression, security infrastructure, and years of permitting and environmental review, long before a single tenant signs a lease. Even before construction begins, owners often pay to lure the anchor stores they need, sometimes covering a share of a department store's own build-out costs, because a mall without a recognizable anchor struggles to convince anyone else to sign. It is an unusual kind of business, where the landlord sometimes writes checks to its own tenants just to get the project off the ground. And delays are where the math turns dangerous. Because construction loans accrue interest whether the mall is open or not. Property taxes start whether tenants have moved in or not. Every month of delay is a month of pure expense, with zero revenue arriving to offset it. No project shows this better than American Dream, the mega mall built in the New Jersey Meadowlands. When it broke ground in 2004, the plan called for roughly a $2 billion retail and entertainment complex, expected to open around 2007. Then the environmental fight started. Then financing partners changed hands. Then Lehman Brothers, one of the project's key lenders, collapsed in 2008, freezing construction almost overnight. Ownership changed again. Financing structures were rebuilt from scratch. By 2011, the unfinished shell had already cost close to $2 billion, and it still had not opened a single store. The Gurmezian family's 555 group eventually took over, redesigned the whole complex, added a water park, a ski slope, and an indoor amusement park, and pushed the total price toward $5 billion. The mall finally opened, in stages, starting in October 2019. 6 months later, the pandemic shut it down entirely. New Jersey taxpayers ended up backing roughly $1.2 billion of the project, the largest public subsidy in the state's history. What began as a 2-year, $2 billion plan became a 20-year, $5 billion odyssey before it ever proved it could reliably pay its bills. That is the danger sitting underneath every mall project before it opens. But suppose the mall does open, on time, on budget. Now you get to the first revenue engine, and it looks incredible. Base rent. You lease space to tenants. A large anchor department store might pay somewhere around $8 to $15 per square foot annually, because anchors draw crowds and get favorable terms. But the smaller shops squeezed between them, the ones that actually depend on that crowd, often pay $25 to $60 per square foot or more. Multiply that across hundreds of thousands of square feet of leasable space, and the number on paper looks enormous. But gross rent is not profit, and it is not even guaranteed. Retailers will only pay what their sales can support. Industry data shows that a healthy tenant keeps its total occupancy costs, rent plus fees plus taxes, somewhere between 8 and 15% of its sales. Push a tenant past that and the store becomes unprofitable to operate, and eventually it closes, whether or not the lease has years left on it. Your rent roll is only as strong as your tenant's cash registers. So owners built a second revenue engine, one tied directly to how well tenants actually perform. It is called percentage rent. Many leases require tenants to pay an extra slice, often 5 to 8%, of any sales above an agreed threshold. If a store has a spectacular quarter, the mall owner shares in that success without having sold a single item. This is a much better business than fixed rent alone, because it means the landlord's incentives and the tenant's incentives finally point in the same direction. Both sides want more shoppers, more spending, longer visits. But even percentage rent is not where the real interesting money hides. There is another business quietly running inside the first one, and most shoppers walk past it without noticing. It is called Common Area Maintenance, or CAM. Every mall has spaces that no single tenant rents. The walkways, the food court seating, the restrooms, the parking structure, the landscaping outside. Someone has to clean it, light it, secure it, and repair it. Mall owners bill tenants for their share of those costs, typically somewhere between $5 and $12 per square foot annually. On paper, CAM is described as a pass-through, simply covering real expenses. In practice, landlords control exactly how those costs get allocated, and anchors with negotiating leverage frequently secure capped or discounted CAM rates, shifting more of the real cost onto smaller tenants who have far less power to push back. A CBRE study found CAM charges alone can make up as much as 15% of a tenant's total lease costs. It is not simply maintenance. It is a second, quieter layer of income sitting on top of rent, and mall owners have every financial incentive to keep it that way. There is a third layer too, smaller but growing fast. Digital screens near entrances, kiosks in the middle of the walkway, pop-up stalls that rotate every few weeks. None of that space belongs to a tenant. It belongs entirely to the mall, which means the mall keeps every dollar it generates instead of splitting it with anyone. A short-term pop-up might run for only 2 to 12 weeks, but per square foot it can outturn a permanent tenant several times over, because the landlord is briefly acting as its own merchant instead of just a landlord. Then there is the design of the mall itself, and it is not accidental. Anchor stores are placed at opposite ends of the building on purpose, so that the walk between them forces shoppers past dozens of smaller storefronts. Escalators and elevators are frequently tucked away from main sightlines, encouraging longer walks past more windows. Food courts sit deep in the interior, so hungry shoppers have to pass through retail corridors to reach them, and then pass through them again on the way out. None of this is about aesthetics. Every layout decision is a revenue decision. More walking past more storefronts means more impulse purchases, which means healthier tenant sales, which means higher percentage rent and lower turnover. Now flip to the cost side of the machine, because this is where the profitable-looking business starts to look fragile. Property taxes, insurance, security staffing, utilities for enormous shared spaces, ongoing capital repairs to roofs, parking structures, and HVAC systems that serve millions of square feet, and debt service on whatever construction loans finance the building in the first place. Almost none of these costs move with how many shoppers walk through the doors on a given day. A mall with half-empty parking lots still pays its property tax bill in full. It still runs the escalators. It still pays interest on its mortgage. The revenue is variable, the costs are fixed. And that mismatch is the seed of every mall collapse in American history. Which brings us to the central trap. It has a name in the industry: co-tenancy risk. Most leases with smaller tenants include a clause protecting them if a major anchor closes, or if the mall's overall occupancy drops below a set threshold, often somewhere around 70 to 80%. If that threshold is breached, tenants can demand reduced rent, sometimes by as much as 50%, or in some cases exit their leases entirely. One anchor store closing does not stay a contained problem. It can trigger a wave of rent reductions across the entire property, which lowers the mall's income, which reduces its value, which makes it harder to refinance its debt, which puts even more pressure on the next round of lease renewals. One problem doesn't stay one problem. Look at CBL and Associates, once one of the largest mall owners in the country, with more than 100 properties across 26 states. For years, CBL's business worked exactly as designed. Then, in the years leading up to 2020, several of its most important anchor tenants, including JCPenney and Ascena Retail, slid toward bankruptcy of their own. Co-tenancy clauses across CBL's portfolio began triggering rent reductions. Net operating income across its core properties, which had been $547 million, was projected to fall to roughly $450 million the following year. In June 2020, CBL skipped an $11.8 million interest payment. By October, it filed for Chapter 11 bankruptcy, wiping out roughly $1.5 billion of debt through a restructuring deal with its creditors. CBL's malls did not disappear overnight. The company simply discovered that its fixed debt payments no longer matched its shrinking, increasingly conditional rent roll, and there was no way to close that gap fast enough. CBL was not the only major mall owner to hit this wall. Years earlier, General Growth Properties, at the time the second largest mall owner in the country, filed what was, at that point, the largest real estate bankruptcy in American history, after its enormous debt load collided with a credit market that suddenly refused to refinance it. Different decade, different trigger, same underlying disease. Too much fixed debt sitting on top of revenue that depends entirely on other people's businesses staying open. So who actually wins at this game? Look at Simon Property Group, the largest mall owner in the United States, with ownership stakes in more than 230 properties. In 2024, Simon generated nearly $6 billion in total revenue, kept occupancy above 96%, and pushed base minimum rent up to nearly $59 per square foot. The following year, it collected $4.8 billion in real estate funds from operations. Simon's advantage is not a secret formula. It is scale, diversification, and negotiating power. When a struggling apparel chain like Aeropostale or Forever 21 threatened to disappear entirely, Simon partnered with a brand licensing firm to help keep those retailers alive across its properties, protecting its own rent roll in the process. A company with over 200 malls can absorb the loss of a handful of struggling tenants in a way a company with a dozen malls simply cannot. Scale does not just add revenue, it adds resilience. Scale also changes what a mall owner is even allowed to negotiate. A single property owner facing a struggling anchor has almost no leverage. The anchor knows the landlord needs it more than it needs the landlord. But an owner with over 200 properties can tell a national retail chain, "Keep your stores open across our whole portfolio, and we will work with you on rent." And both sides know that offer is worth something real. Scale turns the landlord from a supplicant into a partner big enough to shape the retailer's national strategy. That is why the same lease clause that bankrupts a small operator barely dents a company the size of Simon. None of this stands still, either. The industry ordinary shoppers see is quietly becoming a different business behind the scenes. Malls with strong foot traffic are increasingly selling that data itself, treating shopper movement patterns the way a website treats ad impressions, and charging brands for placement based on measured attention rather than just square footage. Struggling malls, meanwhile, are converting empty anchor boxes into apartments, medical offices, and fulfillment space for online retailers who still need to get packages to nearby customers quickly. In effect, some of the most successful malls are quietly becoming smaller, denser, and less dependent on traditional retail altogether, while some of the weakest are being partly dismantled and repurposed into something that no longer resembles a mall at all. Every one of these shifts follows the same logic as everything before it. Does it bring in more revenue, cut a fixed cost, or remove a risk? The malls that answer that question correctly keep compounding. The ones that don't eventually stop existing. So does owning a mall actually make financial sense? At small scale, with a handful of properties and heavy construction debt, the answer is often no. One anchor closure, one recession, one shift in consumer behavior, and the fixed costs overwhelm the fragile, tenant-dependent income. At large scale, with dozens or hundreds of properties, deep tenant relationships, and low-cost access to capital, the same business becomes one of the steadiest income machines in American real estate, throwing off billions in cash flow year after year. So if you do decide to own a mall, understand what you are really buying. You are not buying a building full of stores. You are buying a crowd and renting access to it to everyone else. The building will stand for decades. The crowd is never guaranteed for a single one of them.